Good afternoon and happy Thursday, everyone. It is Scott Wolders with River Place Capital. It is Thursday, October the 21st. Wanted to just take some time to talk about what markets did last week, where we are in earnings season and what we see moving forward. But more importantly, also wanted to talk a little bit about what do you do as interest rates are continuing to march higher if you own long duration bonds in your portfolio, and I will touch on that here in just a little bit. Last week was a very solid week in the equity markets. The S&P 500 finished the week up 2.10%. The mid caps were a little bit better, up 2.5% exactly. And the small caps, as measured by the S&P 600, were only up 60 basis points, so lagging behind, but still the leadership year to date, which is very encouraging and very healthy for equity markets, as those are your more cyclically oriented names and more economically sensitive names, and it's great to see them continue to take a leadership mantle moving forward. And we are starting to just now get in the very beginning part of earnings season, and for the most part, earnings have been very good. Companies have been talking about how they're able to pass on some pricing increases onto the consumer, how they're able to keep margins, and the companies that are speaking that way are benefiting. One of the biggest beneficiaries we've seen so far from earnings this year have been the banks. They're very much in inflationary times, they're a great asset to own, and going to kind of talk on this, but they're a great hedge against long-term bonds, and continue to see the banks move and march higher as interest rates move higher. And as we're talking right now, the 10-year Treasury is trading around 1.67%, up significantly from just 2 weeks ago all the way down to 1.5. So quite a move upward in the 10-year Treasury. So as we move forward into next week is the busiest week of earnings season. We get a lot of our big cap tech names earnings next week, and we will be able to digest and learn more from what they have to say and what they see moving forward. But what I really wanted to touch on today is, what do you do if you own long duration bonds in your portfolio as interest rates are starting to rise and creep up? Well, what happens in a rising interest rate market is those costs, or what you owe on that bond, becomes depressed as interest rates go up. People are not willing to pay for your bond anymore because they can find a new issue that is going to pay them more money, and so you find that you can't find buyers for your bonds, and you have to sell at a very discounted rate from what you purchased the bond at. And so what we encourage at River Place, especially in a rising interest rate environment, is to stay very short if you're going to have fixed income in your portfolio, is to keep those durations very short, so as each time as you come to maturity, you're rolling into a higher interest rate vehicle or instrument every time that you're rolling your bonds. But we encourage our investors and investors out there that are looking for long-term bonds to, in a rising interest rate environment, to kind of press the brakes a little bit, keep your duration short, as in inflationary times. And you have very well-respected experts coming out saying, inflation is the death of the 60-40 portfolio. If you have the 60-40 portfolio, you need to move more towards equities, as you're going to get hit really hard in the bond portion of your portfolio as rates and inflation creep up. So if you have questions about how to manage this and navigate this in your individual portfolio, or questions about what you've seen so far in earnings this year, feel free to give us a call. We'd love to talk to you about it. You can reach us at 904-346-3460, or as always, check us out online at www.riverplacecapital.com. I hope everybody has a wonderful rest of your week. Talk to you next week. Thanks so much.